I want to bring into this conversation Bill Eigen. He is the Chief Investment Officer of the Absolute Return Fixed Income Group at JPMorgan Asset Management. We've had a wild ride in the equity markets. It's been quite a thing to see. These guys are stuck.
Yeah.
Given the inflation picture and the unemployment picture, they're smacking against each other in the wrong directions.
Yeah, what's interesting, Andrew, is 10 and 30-year yields are higher now than when Fed funds were over 5%. Right. So for all this easing, the long end isn't really responding at all.
And that's a really important point.
Yeah.
For all the pressure that's being put on the Fed to do this, they don't have control
There's
over
a lot
the
of
things
pressure
that are going to impact mortgage rates.
And just the mean things that are constantly said about Powell. I'm just like, good Lord. It's interesting. And, inflation's not going away. I mean, as a small business owner myself, I see it every day, particularly services. We're in the process of putting up a building, and you just can't believe aluminum, steel prices, labor costs just continue to move up. So this transitory element, I can't believe that word is still being used, is interesting to me.
Richard Lefrak has said the same thing. When we've had conversations on set about trying to get prices down for housing, he said nothing's going to come down until you can get construction prices down.
100%.
That's where you're still seeing a lot of this inflation.
Both commercial and residential. Absolutely. Yep, I totally agree. So,
what do you make of the markets, though, now and the implosion that we're seeing? I won't even call it an implosion because you're down 4 or 5%. There's a lot of volatility. It's happening rapidly, and we've been used to a market that's gone nowhere but up for the last 7 months.
I think the credit markets are a tell here, right? And I think the sheer amount of debt that's been taken on, not only by technology companies, and especially in the case of a lot of the ratings arbitrage you see going on, like a lot of this debt is being funded through special purpose vehicles or synthetic risk transfers. In the case of life insurers, they're moving a lot of risk to captive reinsurers, and that creates issues and opaqueness. And again, I get it. You have a stream of liabilities. These life insurers do. They want to make as much as they can on their assets, and they want to do it in a way that reduces their capital charges as much as possible, right? So you move it offshore to a captive reinsurer, and you put a lot of private stuff in there that yields you a lot more. But the problem with that is if you have an issue and suddenly these annuity and pensioners want their money back or want to withdraw, and you got to dig into the less liquid part, then you have a problem.
So
right?
you think we're walking into a private credit problem?
I think we potentially are. Yeah, I think there's been.
What does that look like, though, to you?
Well, it's hard, right? Because it's so opaque, right? There's no bid offer. There's no active bid offer. Like, for instance, you saw what happened. You've seen what's happened with a few of the firms just over the past couple weeks, where Renovo, which was marked at par on most people's books, suddenly just written straight down to zero because there's no bid offer. You don't know what it's worth until something happens, right? And then very often it's worth far less than where it's marked on the books. And that's the main issue. There's no active bid offer.
So the good news is it's hard for there to be a run on the bank in these contexts, I think, because you don't have this mismatch in terms of timing where a depositor can walk in and say, I need all my money back.
Right.
But the loan is still outstanding. And so what I don't know is when a loan goes bad, if you will, in the private credit space, or even an entire portfolio goes bad. When I say goes bad, meaning it is worth less than whatever it's supposed to be worth. Does the fund, some of these funds can actually extend out the length of the actual fund itself. So you could create sort of a series of almost zombie-like companies. And I wonder whether rather than being a popping of a bubble, it's like a hiss for like a long time.
Yeah, I guess it all depends on investor mentality, right? Like if suddenly there's a run, like people panic, much like they did in 2008, and that's part of the reason why AIG pretty much went away. If you have that type of withdrawal activity, that's a problem because you're going to work through your liquid stuff very quickly. Then you're into the illiquid stuff, and that's where the problem begins. Like, how do I get rid of this? Like, you're going to have to either gate it, and you know what gates do. Once a fund or anything gets gated, that creates more panic.
Right.
I mean, you saw what happened, with this BDC merger last week, right? Yeah. That was a disaster. that went away. You saw what happened. A major firm just had a CLO that got attached at the lower tranches, so they waived their fees to offset it, right? So you're on the verge of something happening.
So explain this. Everybody's, super anxious.
Yep.
It seemed yesterday morning when we were on this broadcast, after the NVIDIA earnings on Wednesday, that people were relieved. They thought, okay, maybe all of this hand-wringing was a little overboard. Yep. And then all of a sudden they said, maybe the hand-wringing is not overboard. What is happening here?
Well, so I watch the credit default swap markets very carefully, and you've watched what's happened with some of these hyperscalers, right? Oracle especially. Their CDS is blown out from 40 to around 115.
That's been amazing.
120, right?
Jim Cramer did a really good job of laying all of this out.
Yeah, I mean, you really need to pay attention to those markets because they give you clues as to what's potentially happening. Like, it was always a mystery to me how, a company like that took on all this debt, and they added basically $150 billion in market capitalization to their stock while the CDS was starting to blow out.
Right.
Right now, they're starting to meet now. The market cap's turning down, the CDS keeps going out. So I don't think it's the first of this you'll see. I think there's, unfortunately, when you build up this much debt, and like you talked about, this market's been in a straight line up for so long, people forget what it's like to lose money. And that creates an environment of no fear. And an environment with no fear is one you have to be very, very careful about, particularly when leverage ratios are high and when there's this much debt in the system.
So you think this is just the return of fear to the market, and that's what we're kind of watching?
I don't think there's much fear in the market at all, to be honest with you. I mean, people think like a 19 VIX is something crazy. That used to be normal.
Right.
And now,
north of 25.
Yeah, well, it's just like, people look at the high yield market and spreads are, under 300 basis points. Those are right around all-time tight levels. My issue, I'm a fixed income manager, right? So I look at spread product like high yield investment grade, et cetera, collateralized CMOs, CLOs, you name it. They're all trading near record tight levels. So the amount you're getting paid to own this type of risk is basically the lowest it's ever been.
Can I ask
so
you,
the math doesn't
can I
work.
ask you a crazy question?
Sure.
This may be a crazy question. Was it a mistake for Powell and the Fed to already lower rates the way they did this fall? Was that a mistake?
I don't like to second guess people. What I will say is...
No, but you can't. In retrospect, you can.
It didn't seem necessary. You and I talked about this last time I was on. I said, I don't know why they're bringing rates down. Remember I said last time we were on a few months ago, I said, next week they're going to lower rates. I don't think they should, but I know they're going to because there's a lot of political pressure there.
Well, that's what I was going to say. For the last year,
yeah,
there's been pressure from the president
yep.
to lower interest rates.
I mean,
we've been told over and over that they need to lower interest rates, and now we're in this sort of uniquely...
And yet mortgage rates are stuck in this range, right in the mid-sixes, where they've been for a long, long time. So if the whole goal is to stimulate housing, through rock-bottom mortgage rates, I mean, the zero rates are not walking through that door anytime soon.
You just mentioned mortgages, and we haven't seen you since this was announced. What do you think of this 50-year mortgage idea? I
don't like it at all.
Because?
Because, a 50-year amortization schedule, I mean, think about that. You won't own the ability to own. The reason you want to own a home is to build equity.
Right. You won't even have any equity for the first 30 years.
That's exactly, and that's my point. It's like it's this mythical ownership, right, with a 50-year mortgage.
So it's really renting.
Yeah, I mean the concept of portable mortgages, I understand because the big reason people don't want to move out of their houses, they have a very low mortgage rate and they can't get it now, and once they sell it, they got to get a higher one. So I understand the concept behind that. How it'll work, I'm not really sure.